What is the secondary market, the secondary debt market?
Well, if you are in debt, and whether it's credit card debt, payday loans, any of these kinds of debt, medical debt, and you don't pay, the lender can sell that debt to a secondary market full of debt buyers and brokers, like a shadowy, speculative market. And then, but they sell it for pennies on the dollar. So, for example, if you owe $100 in debt, the lender can actually sell it to the secondary market for between $5 and $20, depending on the kind of debt. So what that means is then the debt collectors come after you as the debtor and try to collect the full amount. So, and also the lender who sold the debt to the secondary market gets to write off the debt and get a tax break. So it's like a mini bailout for the lender. They are winning every way they can. And also many of the firms that issue the credit lines in the first place also own debt collection firms. So it's really, it's a very twisted, it's a twisted web. So, but this is very, very profitable. In New York City alone, over a 2-year period, the secondary debt market extracted about $1 billion from people on the secondary market who owe debt. And these are people that are the poorest and most vulnerable in our society. They target low-income communities, and they often they have the courts on their side, the debt collectors and debt buyers. Judges often issue judgments against debtors, allowing bank accounts to be garnished, allowing Social Security checks to be garnished. In many cases, the debtor doesn't even know that they've been sued until their wages or benefits start disappearing from their bank account. So this is a very predatory, very shadowy, very corrupt system, and it really is kind of the essence of the debt system, and the essence of capitalism is that one person's debt is another person's profit.
So, in other words, debt becomes a commodity.
Exactly. Debt is a commodity, but, this is also a system that traffics in human misery. That these are people who, are in the case of medical debt, the Rolling Jubilee is right now focusing on a major purchase of medical debt. So these are people that are in debt because they got sick, because they had an accident and they didn't have insurance, or in many cases they did have insurance, but it wasn't enough to cover the fees from the hospital and doctors. So this is actually a market that traffics in people suffering, and that's what we're talking about.
When did that start, that debt become a commodity? Do you know that?
I mean, you can trace it from a number of different places. I sort of trace it from the 1980s. After the savings and loan crisis in the United States in the 1980s, this secondary debt market banks were over leveraged, and they needed to unload a lot of the bad debts that they had in their books. And so this secondary debt market that now exists was created in the 1980s as a result of a banking crisis. And so again, it allows these institutions who issue credit lines, when they get in trouble, to just sell the debts to another market, and then those debt buyers and collectors try to collect from debtors.
Can you erase individual people's debt? Is that...
No. Debts are sold in bundles, in anonymous bundles that are marketed together as part of a package, so we don't know whose debt we're purchasing in advance. It's not possible to know that. We can find out who the debtors are after we purchase the bundles, and then we can contact them, which we are doing, and let them know what's happened. But before we buy the debt, we don't know.
What is the ultimate goal of Rolling Jubilee?
Well, there are, I think, 2 goals. One is to give concrete relief to some debtors. I mean, we are going to be canceling the debts of people who have, in the case of this current debt, buy medical debt. So this is a concrete relief that we can give people, and we're very proud of that. But I think a more important, or equally important part of this campaign is that it's about public education. Most people don't know that the secondary debt market exists. They don't know that their debts, they don't know that your debt can be written off and is written off, but just not to you, the debtor. It's sold for pennies on the dollar to the secondary market, and then they try to collect from you. People don't know that this is happening. So the Rolling Jubilee is really about public education and about shining a light on this predatory industry and giving people a sense of what's happening behind the scenes, and how people are profiting from their indebtedness.
But won't the price of debt eventually go up if you go into the higher numbers?
I don't think so. I mean, the debt market is enormous. We're talking trillions and trillions of dollars. So the idea that this campaign is somehow going to purchase enough debt to make a dent is ridiculous. It's not possible.
So you're going to go, how long? You're going to go?
I don't know. I mean, we'll see how long the campaign goes on. I think right now it's ongoing, and we constantly are reflecting on what we're doing and making sure that we are putting our energies towards something that's continuing to have an impact. And once we decide that we're not doing that anymore, then we'll move on.
Okay, so and then do you know what's next for them for strike debt after Rolling Jubilee? What are your plans?
Yeah, there are several campaigns that are in the works. Right now, some folks from Strike Debt are working with others in the Occupy movement on a campaign to challenge the MTA fare hikes. In New York City, we have subway fare hikes that are going into effect in March. And in fact, the public transportation system in New York and in cities around the country is financed by debt. So this is really a part of the debt system. And the reason that our subway, train, and bus fares are going up in March is because the MTA, Metropolitan Transportation Authority, owes money to Wall Street for toxic interest rate swap deals. So we're working on a campaign against the debt financing of public transportation. Again, this is all about what are public goods? What are public resources that we should all have access to? And public transportation, we believe, is one of those. In conjunction with the next Rolling Jubilee debt buy that's going to happen, I think, in February, if all goes well, we are going to release a major report about medical debt. Medical debt's another one of these things that a lot of people don't know about, or they don't know the extent of the problem. So we're going to release a report about medical debt to kind of educate people about this really awful industry that traffics in people's illness, sickness, suffering. And there are a number of other campaigns that are ongoing. We have a collaboration in the works with Occupy Sandy to deliver aid to hurricane victims. But we also want to make sure that we're bringing our debt analysis to that work. I mean, much of the aid that's being dispersed to Hurricane Sandy victims is debt-based aid. FEMA wants you to take out a loan to rebuild your house. And so we're trying to, again, publicize that what is being described often in the media as aid or assistance is really debt.
What are interest rate swaps and toxic interest rate swaps?
Okay, let me see if I can explain this. An interest rate swap is a kind of financial derivative, and what happens is it's a deal that many public agencies made with the banks before the financial crisis. So, for example, when they're issuing a bond, which is really a loan, when they're getting a loan from a bank, they determine the interest rate by a swap. So, for example, if I'm a public agency like the MTA, I agree to pay a fixed rate of interest to the bank who is underwriting the bond. But the bank agrees in turn to pay back to the public agency a floating interest rate that's based on various factors. I know, it's wonky, right? Including LIBOR, which is the London interbank offering rate. But what happens is after 2008, the economy crashed and interest rates were artificially lowered to almost nothing. So what happens is the banks end up paying almost nothing back to the municipality or the public agency, and the public agency is still paying the fixed rate back to the bank. And so this has cost countless municipalities across the country to have enormous debts to Wall Street that cannot be paid. For example, the Metropolitan Transportation Authority, that operates the transportation system, since 2008, they have lost about $600 million in interest rate swap because of this interest rate swap deal. And it's impossible to get out of these deals almost. To cancel the interest rate swaps, in many cases, there's a termination fee. It would cost more than just to keep paying. So it really is a kind of hostage situation that banks have municipalities and public agencies kind of in a vice grip of debt, and it's very, very hard to get out of. So we're trying to raise awareness not only about the interest rate swaps as one particular financial derivative, but also that the whole system, many municipal governments are financed by debt, and that's kind of the essential problem that we're trying to expose.